What I'll talk about in today's video is why I would recommend not funding a whole life insurance policy with a one-time lump sum if you're interested in the cash value. So when it comes to funding a whole life insurance policy, a lot of times individuals are interested in the cash value because they say it's a safe place I can put money. I can access it anytime without penalty, and if I do everything right, it is tax-free, which everyone likes tax-free. So what we're going to look at in today's video is someone who is 60 years old. He has a lump sum of $300,000. He wants to put it into a whole life insurance policy for the cash value. This is similar to a situation I ran into years ago when I was early on in my career. Someone who was about 65 years old had a lump sum of about $1 million. And this was back in 2015. The dividend rate was about 7% with the life insurance company he was considering his product with. He asked, Steve, if I just write a check for $1 million, wouldn't I start to earn that 7% dividend right away? I get the compounding. That gives me the most money, right? It doesn't with a life insurance policy, unfortunately. We're going to demonstrate that, the reason why it doesn't work like that in today's session. So what we're going to look at first is a one-time payment. The 60-year-old individual moving $300,000 into a life insurance policy. Now, he likes it because of the tax benefits. How you can mess up a life insurance policy with respect to the tax benefits is if we trigger what is called a modified endowment contract. It's a taxable event on a life insurance policy. So all that means is we need a $300,000 MEC limit. At his age of 60, he needs a death benefit of about $3.6 million. It's a lot of money. Why it's so high? Because he is saying, I don't care about the death benefit. Well, $3.6 million in life insurance gives him a $300,000 MEC limit. Now, the hard part about this with a one-time payment is the premium is still going to be due through policy year 7. I'll show you that when we look at the numbers. But that'll be the one-time payment. And then we'll look at the fort payment option, which he's going to get the same $300,000 into the policy. The difference is it'll be over 4 years. So $300K divided by 4 years comes out to $75,000 per year. Because we're only paying in $75,000 per year, this means we don't need as much life insurance to prevent a taxable event or a MEC. So the death benefit is about $900,000. That gives him a MEC limit of about $75K. Very easy to follow. I know it can be confusing. Let's just look at the numbers, and this will help when you can see everything side by side. So what we've got here are our illustrations. I'm not going to go through these in detail because I know it's a lot, but everything you're going to see on Excel is based on what I just had up here. So, option 1. I wouldn't do this. He writes a check one time for $300,000. Over here is his premium, and we also had to attach this term insurance rider. Without getting into the details, these are expenses that are tied to the policy. Now the first year he pays in $300K. His cash value is about $263. So if this is you paid in $300, you have $263. Did you make any money? No. He lost about $37,000. Now after this, he pays 0 forever. What's going on with this? Those are the costs that are still due. He's not paying it. The policy is first covering the costs, then anything left over comes back into cash value. This is what I like to call drag. Now sometimes people ask, hey, can I just pay that in order to cover those costs out of pocket and let my cash value grow faster? The answer is yes, but in his case, he was interested in life insurance for the cash value. He wanted to move $300K in and be done with it. So he did that. He doesn't pay anything else in, but how does that cash value look? takes more than 10 years just to get his money back. Not a great place to put your money. This shows what your money is growing by every year. So for a little bit, he loses money until we're able to drop the death benefit. We can't drop it earlier than the 7th year, or I should say the 8th year. The reason why has to do with that MEC limit. If we reduce the death benefit, which will stop this from happening, will trigger a taxable event. So, with all of that said, here's a different lump sum option. He pays in the same $300,000. This is with the same company and product. What happened here? We just lowered that premium. Look at this. Does that look better than the last one? You're at 263 in the last one. So it looks better, but would you want this? Probably not, because you grow a little bit, then you start to go down again, then back up, and without getting into the weeds here, it takes 10 years to get your money back. The reason why, again, drag. These expenses are due. You're not paying them. The policy is paying it for you, and anything left over is resulting in your money growing. Okay, last option. Then we'll look at them side by side. Here's the same product. Here's the same $300,000 going in. What's the difference? $75K per year for 4 years. By the 4th year, you've paid in $300. You have $300. How about your death benefit? Do you remember what it was in the last example? So at $3.6 million. Here, it's just over $900,000. Why it's 905 is because that gives us a MEC limit of 75K. 900 was not enough in this particular example, so we needed just a little bit more. But a couple things here. We're funding it for 4 years. That's 4 years where those expenses are covered by our payment. First, we're covering the premium, then the term rider, then we stuff everything else into the PUA rider. I like to call that a cash dump-in because I dump it into cash value, baby. It's how I maximize the value. But I'm covering the drag, so now, by the time I hit the 5th year, the premium's due, the term cost is due, but it's not that much. So how I like to explain this is if I'm on a runway and I've got my airplane here, part of my poor penmanship, you're going to be able to tell. I'm not an artist like my lovely wife, but here's my airplane. I'm trying to get off the ground. I'm going. Finally, I'm flying, and by the time I hit the 4th year, I still have this cargo on the plane, but it's light. I'm flying at a fast enough speed where it doesn't slow me down. Over here, it slows down a little bit, but then picks up the pace. And then once I'm able to dump the cargo, when I'm able to drop the death benefit, now I can really pick up the pace. Where when I compare that to the last examples, what happened? Well, the cargo weighed too much, it weighed me down, and I went backwards, which means my engine blew up. So it didn't work at all. So let's look at the comparison here. First, we've got the comparison with all of the details, and you can really see on the far right that term rider is significantly less. That's why that one looks better. But if you said, Steve, this stuff is just too confusing, show me a side-by-side. I hope this helps. So here are the 3 examples we looked at. In blue is what you pay. You paid $300K in all of them. And yellow represents when you have $300K. So in what planet would you want to put money into a product and wait 10 years or more just to get your money back? Doesn't make sense, especially if I plan on using it. So over here, I get it back quickly. What happens when you stop paying? Continues to grow. If you look at the 10th year, which one has the most money? 285, 303, $373. It's a big difference. How about by the 20th year? We don't even look at this guy because it's ugly. By the 20th year, $450,000 with the option in the middle. But over here, look at that, $554,000. That's a $100,000 increase just by spreading that lump sum out over 4 years. The death benefit is more than $100,000 than the example in the center too. So just by spreading the lump sum out, instead of paying it all in one shot, gives you a lot more value from start to finish. So why I would not recommend funding a policy with a one-time lump sum is because in the majority of cases, spreading it out over a number of years makes a lot more sense. This individual was in his 60s. If you're 60 years old, usually spreading it out over 4 years makes the most sense. If it's a female, maybe 3 years. If you're 40 years old, we can look at spreading it out over 2 or 3 years. But if we're 70 or 75, we'd probably spread it out over 5 or 6. So age does have an impact. But really why I wouldn't recommend it is because if the goal is having as much cash value as possible, what you'll see in almost all cases is spreading it out is going to give you the most money. The only exception to that is if he said, I want to fund $300,000 up front and then keep adding money thereafter. That's a different story. So with all that said, I do hope that you enjoyed today's video. If you have any questions or thoughts, feel free to leave them in the comments below. You can also DM me as well. And as always, I hope this helps.